Hello and welcome to this Market Structures online lesson, and in this lesson we're going to be exploring the topic of oligopoly. We're going to begin by exploring a few key concepts. To start off with, take a look at the right hand side of your screen. You can see a number of key term definitions, and to the left hand side you can see the associated key terms. Pause the video now and see, based upon your prior knowledge, if you can match each of these terms to the correct definition. Give yourselves around about 2 minutes to do this. Okay, so there might have been some new information for you there. Here you can see our answers on screen and we will go through them now. So to begin with, the association of businesses or countries that collude to influence production levels and thus the market price, that is the definition of a cartel. Collusion takes place when rival companies cooperate for their mutual benefit. The kink demand curve assumes that a business faces a dual demand curve for its product based on the likely reaction of others. Where the decisions made by a business cannot be taken in isolation and it must consider the likely reactions of rivals, describes interdependence. When one firm has a dominant position and firms with lower market shares follow the price changes of the leader is price leadership. And finally, the prisoner's dilemma is the problem in game theory that demonstrates why two people might not cooperate even if it's in their best interests. So that is a number of key concepts and key terms that are associated with oligopoly, and you'll see these emerging as the lesson goes forward. So now we've explored some key words that are associated with this market structure, we're going to go through some basics of what an oligopoly is. Firstly, this form of market structure is best defined by the actual conduct. In other words, the actual day-to-day behaviour of businesses within that market. So when we're exploring a market structure that may be an oligopoly, let's for example use the supermarket industry, we're going to actually look at the behaviour of firms such as Tesco, Sainsbury's, whether one increases prices, whether one increases spend on advertising, to judge their behaviour. An oligopoly is what we call an imperfectly competitive market structure, and within this industry firms have differentiated products. In other words, if we go back to our example of Sainsbury's and Tesco, let's take for example jam. You may be able to buy a certain type of jam at Sainsbury's, and at Tesco you might be able to buy a different type of jam. They may have done something to that product, for example used less sugar or used a higher concentration of fruit that sets it apart from the rest. I'm sure you might be able to think of your own example of how to differentiate a product. The key though is we are exploring this where there's a high level of market concentration. So the market share that each individual firm has, let's think of the supermarket industry again. Tesco has approximately 27% market share, if not higher, in the grocery market. Sainsbury's, that has a high level of market share as well. So the market share that each individual player has is quite high in relation to the overall market itself. That's what we mean by a high level of market concentration. Now we measure this by something called a concentration ratio, and this measures the extent to which a market or industry is dominated by a few leading firms. And a rule of thumb to think or to determine whether a market is an oligopoly is when the top 5 firms in the market account for more than 60% of that market's total sales. So here we would say that the concentration ratio, the 5 firm concentration ratio, is more than 60%. So let's summarise the first few ideas there and think about what the key characteristics of this market structure are. So we're defining it by the actual behaviour of the incumbent firms in the industry. The market's dominated by a few large firms, the concentration ratio is high, products can be differentiated, they can be homogeneous too, but most of the time they're differentiated. There are significant barriers to entry and exit, and if you can't recall what they are, make sure you have a look at one of the earlier online lessons, particularly Introduction to Market Structures. And there are interdependent strategic decisions by firms. In other words, what we mean here is that the decisions that firms make are influenced by one another. Let's have a look at the idea of high market concentration in a little bit more depth. To define a concentration ratio, it's a measure of the total output produced in an industry by a given number of firms in that industry. So, if we're thinking about how we measure these concentration ratios, you can see two common measures that are on screen now. The 4-firm concentration ratio means adding together the biggest 4 firms' market share within an industry. Subsequently, the 5-firm concentration ratio means adding together the biggest 5 firms' market share, and so on and so on. Let's have a look at some quantitative skills practice. On screen you can see some market share statistics of the UK grocery market. I think I might have been a little bit out before with my reference to Tesco. The chart shows the market share for the UK grocery market in June 2020. What we'd like you to have a go at is to calculate the 5-firm concentration ratio. If you recall the previous definition with regard to what the 5-firm concentration ratio is, pause the video now and have a go. So, we're adding together the market share of the top 5 firms. Tesco at 26.9%, Sainsbury at 14.9%, Asda at 13.9%, Morrison's at 10.1%, Aldi at 7.5%. Add those all up together and we will have a 5-firm concentration ratio of 73.3%. Is this an oligopoly? How can we be sure? Yeah, it is. Remember the rule of thumb that we said before? The 5-firm concentration ratio is greater than 60%. So with that in mind, we can say that this industry is oligopolistic. Let's have a think. Look back at the characteristics of oligopoly. How many other examples of oligopoly markets or industries can you think of? Pause the video now and give yourselves 2 minutes or so. You might have come up with some of these: airlines, broadband providers, vehicle manufacturers, high street banks, pharmaceutical companies, cinema chains, fizzy drinks makers, household goods and fuel retailers. These are some common examples of oligopoly markets and industries. Let's explore one in action a little bit further and look at some petrol retailers. Here you can see the market share of motor fuel sold in petrol stations in the UK in 2018 by brand. Calculate the 5-firm concentration ratio. Pause now. Okay, hopefully you got 66.7% by adding together the market share of the top 5 firms. Let's have a look at the cinema industry now. Different one this time. What's the 3-firm concentration ratio? Pause now. 70.1% is what you should have got. Now, it might surprise you that the cinema market is an oligopoly industry, but bear in mind that many cinemas in many counties in the UK might often be independent. And if we look at that, others at the bottom of our screen there, the 19.9% share, just shows how prevalent independent cinemas are in the UK. So let's have a look at what the term interdependence means. Interdependence means that one firm's output and price decisions are influenced by the behaviour of competitors. And we can make this into an extended chain of analysis. Now, this is a really important skill for any writing that you do, whether it be a data response or an exam question. So let's take it step by step and unpick it. So because there are few sellers, each firm is likely to be aware of the actions of others. This means that the decisions of one firm influence and are influenced by the decisions of other firms. And as a result, firms in the market must take into account the likely reactions of their rivals to any change in price, output, or forms of non-price competition. This might be advertising and branding, for example. This market behaviour is a key aspect of business competition in an oligopoly and can be modelled by the use of game theory. This causes oligopolistic industries to be at high risk of tacit or explicit collusion, which can lead to allegations of anti-competitive behaviour. And consequently, in an oligopoly, there is a high level of uncertainty. So this is a chain of analysis that explains the meaning of the term interdependence, which is of course one of our key features of this market structure. Here on screen we can see a familiar cost and revenue diagram. Now you may wish to use this diagram to illustrate a firm within an oligopoly that has some price making power. Later on we will introduce the ideas of game theory and the kink demand curve to illustrate interdependence and uncertainty within this market structure. So I might use this diagram on screen, for example, if I was to illustrate the price making power of Sainsbury's within the supermarket industry that we know is oligopolistic. And I might be trying to argue that Sainsbury's can earn supernormal profits within this oligopolistic industry.